of October 2017. So we're going to start off just reviewing the ECB event that we saw yesterday. And what we managed to see was Draghi pull off a tapering of half his, in terms of asset purchase per month, go from 60 billion down to 30 billion, extend out for another 9 months and actually allow the euro to fall quite dramatically. So it's quite an interesting event, I think. If you look at where the market was positioned going into this event, it can make sense, but I still think Draghi has managed to once again engineer quite a phenomenal monetary policy event where he's, in essence, tapering is still a hawkish event, and he managed to bring down asset purchase programs by half, even though the market was expecting only about a month ago that a tapering of 40 billion would have been sort of the more hawkish event. But as communication changed and he used source comments from the ECB, market expectation for the taper started to change. We were seeing ING expecting a tapering down to 25 billion and extending for 9 months. So what we saw is, as they announced 30 billion in extension for 9 months, we saw the euro come under some pressure, breaking through pivot, and then there was some good technical trading on the way down. But I feel like this move was less due to the asset purchase program announcement, and more due to the fact that there was no any other change in the underlying tone that Mario Draghi presented. He was still as dovish as ever, talking, basically reaffirming that quantitative easing will continue as long as inflation doesn't pick up, and we've been seeing that inflation has been quite low in the Eurozone. So I think the market was disappointed on that front, that there was no other hawkish tone to his underlying message. Some of the comments that we did see come out was, he's quite bullish on the growth of the economy. So he noted that economic expansion of the Eurozone continues to be solid and broad-based, but added that domestic price pressures are still muted. So once again, just looking at the inflationary front, and then also reiterating that he will continue QE if necessary, if inflation doesn't pick up. And I think this is largely why we saw this continued move to the downside. If we just flick across, and I think Draghi must have looked at this and seen that the market was just expecting continued accommodation for the foreseeable future after that, as opposed to this being a hawkish event of him trying to take away stimulus from the market. So after the event, we started to see, this report came out in Bloomberg. ECB sees options for ending QE with short taper in 2018. So seeing almost like people with knowledge of the discussion saying that QE could potentially come to an end right at the end of 2018. So if it's at the moment 3 billion all the way up until September, this is almost suggesting that they may taper that all the way down to 0 by the end of 2018. With then a potential rate hike then coming in 2019. The market seems to have shrugged this off just for now. If we flick back to the chart, the euro has remained under pressure throughout the American session, throughout the Asian session, into the European session. So quite a bit of downside in this market at the moment. Looking at the market technically, we had a head and shoulders over here as a sort of reversal, a left shoulder ahead and then a right shoulder, and then as we ticked down we saw another left shoulder, right shoulder. So looking at it technically, there's almost 2 head and shoulders here, and we've seen that neckline now break. So a bit of reversal there. I'd be expecting this trend to continue in the short term for sure. I wouldn't be looking to be too aggressive on the way down, looking for a bit of retracement and looking to get short into the market. But this is also is coupled with yields falling in your European bond markets. So let's get on to a 60-minute. You can see that initially this is the price of bonds increasing. As the price of bonds are increasing, the yields also decreasing. So we saw that the bonds in themselves did rally, maybe not as dramatically, but then as we've been discussing, this capital key issue means that we may have seen a bigger move in sort of your peripheral European bonds as opposed to your bund. This also filtered through into European equities. So we saw DAX print all-time highs once again. And if I just bring up Euro stocks, still nowhere near their all-time highs, but just testing our 2017 highs actually as we speak, just breaking through now. So this is the 2017 high. Sorry, let me extend this chart out. So 2017 high just being tested, double top, just giving way. And And that really does open up quite a bit of room, maybe 3,700 as your next sort of medium-term target, and then the high we saw back in 2015 at 3,770. But what's quite interesting here is that you can see DAX is printing all-time highs here, as the German economy has been hugely benefiting from this continued accommodation from the ECB, but the fundamentals being strong, the economy being strong. But if you look at Euro stocks and you go into a longer time frame, with European countries, other European countries still suffering and suffering on their way out of this financial crisis, we are still nowhere near our all-time highs here. So it's an interesting, even though they're highly correlated markets, of course they have their own individual fundamentals. So even though they're both rallying at the moment, we're definitely seeing outperformance in the DAX. This is also coupled with the fact that we had Volkswagen share earnings come out. Operating profits of 4.315 billion versus the expected 4.17, so a beat there. Revenues of 55 billion versus expected of 54.5, so a beat on both metrics. And this must be a relief for people in trading German equity markets, given the VW scandal we saw in September 2015, and there's still we're still seeing reports come out around that, and the investigations are continuing. So to continue to see VW outperform, allowing the DAX to move higher, coupled with a weaker euro. So I've been saying this for a little while. I think as uncomfortable as I feel I or many people are with the US equity market, I'm quite comfortable to be going long European equity markets for, you know, a substantial amount of time. Just to couple onto that, if we look at some other supportive evidence of this, if we look at euro area consumer confidence, we printed a pretty good number, so -1%. It's still a negative territory, which does sound bad, but look at where we've come from. From January 2017, -6.4%, all the way down to -1%. Put on a longer time frame. Let's get on a 10-year. Last time we were trading up at the last time we were printing up at these levels was pre-2008. So euro area confidence is building. Your soft metrics are building, gaining momentum. So the euro area is recovering. Plus, we've got this continued accommodation from the European Central Bank, just allowing European equities to continue to tick higher. And the last comment I wanted to make about the European equity market is the IBEX. And what we saw yesterday is, as the Catalan leader announced that he was going to be calling for potentially calling for another regional election, we saw the IBEX rally, because this means that he wasn't going to be calling for the independence that obviously the people voted for, and that means the worst case scenario has now been averted, and the IBEX saw continued upside. Actually quite making a, just get the value up. From the lows to the highs, moved almost 3% intraday. It didn't really finish on the highs, however, quite a powerful move to the upside. So it's going to be quite interesting to see how that sort of develops, but I don't feel at the moment there's any real risk of Catalan pushing forward for its independence calls, which means we're going to continue to see this upside in European equities as a whole, coupled with other factors such as good earnings, cheaper euro, continued accommodation. So the European equity market looking pretty strong right now, the euro looking pretty weak. Also, I just wanted to note, with the euro trading lower, I think this is fine for a short-term strategy. I still believe, though, in the medium to long term, the euro should continue to appreciate as the economic outlook continues to improve for the Eurozone, which should start to stimulate market participants believing that we are going to see a bit more tightening than what we're probably pricing in just now. Moving on from that, we had a couple of things happen in the United States yesterday. Starting off, we had the House of Representatives voted to adopt the 2018 budgets. So this is just, once again, Donald Trump managing to push past these budgets so he can then focus on other things like the tax plan. I'm not sure about you guys, but I'm getting pretty tired of talking about this tax plan. You know, it's been months and months and months, and all we seem to do is just hear that the tax plan is coming, the tax plan is coming. But he has taken one extra step towards it by pushing through these budgets, so then he can focus on the tax plan going forward. So we did see the dollar rally quite a bit yesterday. It was pretty strong on the session. This was another factor contributing to dollar strength, is that Politico report that Janet Yellen was out of the race. And this was quite unique when this happened, because this happened right in the middle of the ECB event. So the euro was seeing some pressure. I think at this point we were trying to just break through the previous day's lows. Let me just get I think it was around there. So this spike that we saw here on the euro, so people were going short, and then all of a sudden we saw this massive uptick in volatility. Gold spiked lower, euro continued to come under pressure, and everyone was just like, okay, wow, what just happened? And then we saw that Politico had claimed that Jalan was out of the race, and this saw some very short-term dollar strength. And as we've been discussing, Janet Yellen is seen as dovish because she has been quite dovish in all of her communications. But at the same time, she is delivering now, coming up to the 5th rate hike and quantitative tapering. So that really was just more of a surprise shock event. I think the market panicked for a second. It was quite uncomfortable holding that trade, especially with that kind of volatility. As it took a little while for us to actually find out what caused the extension of the dollar strength that we were seeing. On the US front, there was a couple other interesting things to point out. We saw earnings come out from your tech names and your tech names. So we saw Amazon report, which was plus 8%, Microsoft report plus 4%, and Alphabet report plus 3%. And Microsoft, Alphabet, Amazon, I'm confident to say that every single person knows who these companies are. They are some of the biggest companies in the world. Amazon to print a plus 8% beat. I mean, that's just phenomenal. This is just showing that continued growth in the United States equity market. And this was reported after hours. Maybe a 30-minute chart here. This is the Nasdaq. As soon as that release came through, 9 o'clock, we saw immediate upside, and we've continued to see the Nasdaq print for session highs, now testing R1 as we speak. I think it's now fair to say that. And people ask, well, how do you plan your trades? Well, I think it's fair to say that the Nasdaq is going to print fresh all-time highs again today. So it's now so I'm pretty confident in that call, but now it's just trying to catch this move higher. So that's almost like saying we're trading here, and I can say with quite a bit of confidence and conviction that we should at least go to test these highs, which means that, well, your trade plan is there. It's to take this equity market to this point up here. That's at least what I'm looking to be doing today. The next challenge is then how do I get involved? Is it to be aggressive? Is it to wait for a pullback? And that will largely depend on sort of if you can see continued market interest, if we see the volatility pick up in the Nasdaq, and then take a more classic approach. But that's saying that we're going to see the momentum pick up substantially, and we're going to be looking to enter long at the R1 at 9-10 o'clock, which may not be the right move. In fact, I'd still be preferring sort of a pullback trade to these lows over here. This was also the high that we saw on the 24th, and that would be a good point of entry if that fails, and looking for pivot. Really quite bullish on US equities, so trying to catch this wave higher, expecting it to get all the way through to the all-time highs, if not go to look to test R2, which in itself would then be an all-time high. Finally, I just wanted to point out the sterling chart, what we saw in sterling, and I think this is brilliant. And Sam North, you are right, I am going to take this opportunity to slate Theresa May. We saw the GDP release, a beat on the year, a quarter on quarter, a beat on the year on year, and we see immediate upside in sterling, top of the range, breaking through a very significant price point over here around the 1.325, finding some support. But what we saw yesterday is we managed to break back into this range. We saw some downside taking us all the way down to 1.32, and then this dollar strength outweighing this sterling strength and taking us back, now fully retracing this move. And I don't want to spend too much time on this because, well, what's new? Nothing is new here, and that's the problem. This is why sterling's under continued pressure. There is nothing new here. No developments have been really made in these Brexit negotiations. We're still stuck on the divorce settlement. We're getting comments that now even the Eurozone is preparing for a situation in which there is no deal. And I think one of the biggest issues we need to overcome is the first step, which is divorce bill, and I can understand that it's a difficult topic, and it's sort of showing how strong you are as a leader not to back down. But I think we need to get over this first hurdle and show a good degree of diplomacy from both sides before we can then go into even more complicated negotiations. If we're failing at the first hurdle, what does this say about the outlook of our trade deals that we can actually make with the Eurozone if on the first hurdle we're failing so miserably? Let's not forget we triggered Article 50 in March. So March, April, May, June, July, August, October. We're 8 months in, and there is no sight of us even progressing past the first issue. So this whole monetary policy stance, saying that as GDP is increasing, it puts less pressure. It makes the decision for the Bank of England to hike interest rates less difficult. But in essence, what are they going to do? They're going to hike by 25 basis points. This is not them initiating a hiking cycle or a continued hiking cycle, which would then result in the sterling continuing its appreciation. In essence, it would just be a hike of 25 basis points because they do not want to hit consumer and business sentiment too much. So on one hand, you've got a 25 basis point rate hike. On the other hand, you've got another year and a half, potentially much more than that, up to 4 years if we agree to a grace period, as it is, of complete uncertainty in the British economy. And I think that is what the market is giving more weight to. Is the Bank of England has clearly stated that they're not embarking on a rate hike cycle. It's more just to do with the fact they need to do something to counteract the inflation, and that's a 25 basis point hike. And I think the market has got over that. We understand that that's on the horizon, but other negativity is ultimately dominating this currency pair. Also coupled with the strength that we're seeing in the United States dollar as well, allowing this market to drift ever lower. If we look in a slightly longer time frame, we are still pretty elevated, and I think where we are trading now, far below the lows that we've seen. I think a 25 basis point has been priced in here, and we're going to be looking at the value of sterling as the political and economic uncertainties sort of start to take more significance going forward. Looking at the data calendar ahead, just here. So we got a relatively quiet European morning here. From the United States, we have the GDP advanced readings, which is on the face of it, very interesting reading. We'll just talk about that in a second. You got 130 your USA core PCE price advance. Of course, this is the Fed's preferred inflation measure, so that'll be interesting to keep an eye on. 3 o'clock US Michigan sentiment. These are your final readings, so it'll be lesser importance. Still be keeping an ear out for these. However, we have seen final readings move the markets on occasion, so I would be cautious going into this event. But just going back to GDP readings, even though these are advanced readings for Q3, if you look at what they were previously, 3.1%, the expectations is of 2.5%. So we're expecting actually quite a low number here. And how can we explain this away? We can explain this away by, if I could find the right article. Sorry guys, give me 1 second. Okay, well, let me explain it away anyway. So this reduction that we're expecting to see in the GDP reading from the United States is mainly due to the hurricane. Of course, we'd see that the economy would not be growing as aggressively in the past quarter, where we've seen 3 hurricanes hit the country. And this is why, whether we get a beat or a miss, I'd be a bit cautious going into this event. As you can see, this is the chart for the GDP growth. GDP growth has been sort of difficult recently, but if you look at the 5-year, definitely seeing an uptrend in the market here. But expectations for 2.5%, this is due to the hurricane effects that we've been seeing. So if we get a lower than 2.5% reading or a slightly higher than 2.5% reading, it's going to be difficult to imagine that we're going to see as much volume enter into the market, just given the way that any anomalies seen in this reading could quite easily be explained away. So just be cautious over here. Don't be going in full size. it'll be very easy to explain away choppy price action afterwards. So you don't want to be sitting there saying, in hindsight, I knew this was going to happen. Look for the volume. Look for, see where the sentiment is, that people are willing to commit their capital and then get involved, as opposed to going straight off the headline number, is how I'd look to approach this. But in terms of what would be considered a bad number, if we dip below your 2% mark, then that'll be quite negative. Okay. Well, thank you very much, guys. That's the brief for today. Please let me know if you have any questions. I'll be in Trading Live. Thank you very much, and best of luck.